Hi, Mickey Fulp, the mercenary geologist, with another of our highly popular CEO interview series. I'm here today with Daniel Major.
Hey Mickey, good to see you.
Daniel is the CEO of Goviex, a uranium company focused in northern and southern Africa, both. And Daniel and I first met about, I think, 3 years ago at a conference in New York City, a uranium conference. I was an invited speaker, and you were one of the chosen 4 or 5 companies there. You got an interesting background, I must say, mate. You're a mining engineer from Camborne in southwest England, arguably one of the best, if not the best, mining schools in the country.
Absolutely.
And you've been focused on uranium for quite some time. You've got lots of experience. So give us a little bit of your background, and then let's segue into the uranium business and what you see ahead.
Yeah, absolutely. As you say, I went to Camborne. I mean, the other CSM are obviously in the USA.
Yeah.
So
Colorado School of Mines, for those people
not knowing that one. I like the uranium story. I don't have a problem with Africa. I think Africa is one of the jewels that's out there for the industry going forward. And so to get back into Africa and get back into uranium was, for me, a great opportunity. It's been a tough call since 2012.
Well,
but things, you know, the fundamentals
are starting to turn
around.
So why don't you give us some of your thoughts on how it's turning around, some of the catalysts that are causing it to turn around, and then we'll get to the tough questions about
No, absolutely. I mean, you know, it has been a long haul. The industry, and you have to go a step back a bit with the whole thing anyway. I mean, in 2011, everything was driving forward. There's substantial growth on demand.
Oh, yeah.
Producers were trying to catch up with the industry as well on the demand side, and everything fell off a cliff with Fukushima.
Yep.
You know, 50 reactors shut down. The Germans suddenly decided they're going to close their reactors, and the production units were still coming on stream. So you had this complete overlay going in the wrong direction.
About 15% of world uranium demand.
And there was a complete switch. So now you had the oversupply, not the other side.
Yep.
Before that, you know, 1985, since 85 onwards, you'd been running in a deficit anyway. The market had run in a deficit, and up until that point, so you'd seen this big pull down of overall inventories that are out there. The problem was the market to have a rebalance coming through.
Yep.
The other problem that was happening is that the governments, the Russian government and the US government, were also switching their inventories out and selling them out to utilities.
Absolutely.
So now utilities were suddenly holding. So what you've really seen in the industry is the industry waiting to react. It's slower to react than maybe the copper industry because of the contract business, but it's slowly been reacting.
True.
You've had inventory pull down slowly as the utilities, but more importantly, you've had China building up inventories at the same time. So when you look at total inventories out there, a lot of those total inventories are held by the Russian and Chinese governments. But those are in depleted...
That's scary.
But they're in depleted uranium for the Russian and the American governments. So those are not really going anywhere.
True.
The Chinese are holding inventories because they've got a substantial growth out there anyway. The rest of the governments, if you look at the US utilities, the European, they're holding roughly what they need. And so one of the issues we've been talking about for a while in investors is that actually there's not a lot of fungible inventory around, really physically available inventory to be had if anybody really wants it. The problem was you still had the underfeeding. The underfeeding issue needed to be sorted out. So one of the problems with the uranium industry is you have U3O8, you got U46, you got enriched. And
you got all these products
pipes,
that you can...
The whole pipeline needed squeezing out, and that's what you've seen happening. And I think our problem as an industry is we've taken longer to recognize that all the pipes needed to be drained.
Okay.
We're in that position now where EU, for example, inventories have fallen for the last 2 years. Okay, inventories are starting to fall. Production cuts have
been tremendous.
Absolutely.
And that's not only disruptions, that's destruction of supply in a lot of instances.
Yeah, and I think the one thing, the big picture on this thing is in the next 5 to 10 years, you've got about 30 million pounds of production that's going to disappear anyway.
Yep.
The production units that are actually coming to the end of their life and just will not produce anymore, and they need to be replaced. In the short term, we've had this tightening up going forward. And so what you're looking at is the really The biggest single factor that's changed is one, the Kazakhs cutting back down, and then Cameco's reaction. Cameco is
cutting McArthur River and Rabbit Lake a couple of years ago.
Well, McArthur is probably the biggest single short-term driver. So our read of this is really, you know, we're expecting, I think the industry is expecting Cameco to extend that cut.
Yeah, that was 10 months, and from what I know, that was the minimum before they had to start furloughing workers, right?
Yeah, so. and they've made it clear that they will buy in the market when they need to buy in the market to cover their contracts. And I think what we're expecting to see, timeline-wise, is that Cameco will come through, announce an extension of the McArthur River because the market hasn't recovered. They will get that extension from the union, and at that point we expect them to be buying in the market. That's interesting, I think, because when you look at the spot markets, what, 40 million pounds a year?
Yeah,
but half of that's trader to trader. So the real market is only 20 million pounds.
Exactly. Yeah. They count it twice.
Well, that's
essentially.
Right. So then you've got Paladin just shut down. That's 4 million pounds of spot material gone. The Kazakhs are now selling a big chunk of material to Yellowcake. You've got Tribeca turning up to buy material as well. So Cameco is going to be coming in looking for 10 million pounds in a 20 million pound market. At the same time, your biggest spot sellers are disappearing out of the market, which means they're going to have to come out of inventory. And so they're going to start be put, and that's what Cameco's strategy is here, as I can see it, is in my view, what they're saying is, look, we need to replace our long-term contracts. The only way to replace our long-term contracts is to drive the spot price back where it needs to be, because the contract market will move. We don't mind if we pay rich on the first year because we'll get 10 years a better price.
There you go.
And so that's what you're going to be looking for, and we think that's third quarter action. Okay,
so we've got some drivers. Now let's talk about Goviex. Let's first talk about your projects and where they are, and you got an immense number of pounds in the ground, so give us some insight in that.
Yeah, and I think that relates to where we see the market as well. I mean, that's where, and I'll answer all your questions there, but where we see Goviex different to everybody else, we're one of the few guys who actually can leverage off that change now. If that change happens today and Cameco come in and the price runs, Goviex is one of the few companies that can turn it into cash flow. Quickly, absolutely. Because the key is we have 2 permitted projects. They've got everything in the ground. So our main project's the one in Niger, Madaouela. That's 120 million pounds.
That's a lot of uranium.
1,400 ppm. It's got all the infrastructure. It's next to the Areva mines. Power's there, roads there, water's there, people are there. I got a government where 60% of the export is uranium. They need a new mine because those mines we're talking...
Fourth or fifth largest uranium producer in the world for a long time.
And their 2 biggest mines are about to close.
Absolutely.
So they need a replacement coming on. We've gone through that permitting, got the PFS. We're looking at $360 million of capital, $25 cash cost. Our focus on that project, we've set it out as a 4-pronged strategy. We said, look, optimize the project. We can still work on that. We've been showing how the addition of the Agal license next door comes in. That adds 5 million pounds of reserves onto the PFS that's not there, and it's all open pittable, and it's the up dip part of the open pit. So that reduces our upfront costs and makes the first 10 years debt financeable on its own without the underground getting involved at all. Underground for us is flat lying at 100 meters.
There you go.
So it's easy. The second thing we've done is been working on membrane technology. That allows us to massively recycle our sulfuric acid. Sulfuric acid is about 10% of my total costs. So if I can recycle all of that, we'll reduce our OPEX by about 10%, our CAPEX by about 6%. Power, we're currently forecasting 20 cents on power. If I can bring it, hybrid power now in Africa is coming in on average at about 14 cents. So what we're focused on is optimize the project, which we can, and we've already shown some examples how we can do that. We've already shown how we can get the debt, because we've got export credit coverage and we've got the debt bank showing how they want to come in, and that's going to be the key. So as the market recovers, we can leverage that. We've already started the offtake conversations. Second project, so it's a year of final feasibility, 2 years to build. The second project, Matanga, sitting down there.
In Zambia.
60 million pounds. We did a deal last year that expanded up, so we've got 3 mining permits lined up there. That's 30 cents. All in cost, it's 120 million capital to get it out.
Wow, that's not very much.
Yeah, for the same production rate that Madaouela's got. So they're all in costs is identical. Low strip, low acid consumption, very quick turnaround, fully permitted project. And then we've got Mali, which is currently 30 million pounds. Needs more work on it, but it has an in-house feasibility study already done on it that was done by an international consultancy company. So we have a fantastic pipeline sitting out there of projects.
Well, it certainly sounds like it. As a kind of final segment here, let's talk about the people that are involved, the companies that have equity positions in Goviex, because these are some big boys here.
Yeah, absolutely. I mean, as the company's developed, it's brought in a lot of strategic investors on here. The first one actually was Cameco back in 2008. They really funded up the major start of that thing. They're still in the company with about 5%. We did the deal in 2016 that brought Denison on board. They're sitting at about 17%. They wanted to leverage up on their African assets, but they wanted to focus on their Canadian stuff, which is why they've stayed with us. We have Ivanhoe Industries in there as well.
Absolutely.
The founder is Govin Friedland, so the son of Robert. So you know, we have those relationships in there as well. So we've got a really good base load. The company as well, when it started, was institutional investors. Since we went public, the focus has been actually on retail. So we actually have a strong institutional base there as well.
Yeah, and you've got a strong retail segment too.
Yeah,
I know that.
We're very liquid as well.
Yeah,
and that's one of the keys for all investors. We are highly liquid as a stock.
Well, you know, as we all know, when markets start to run, liquidity and volume is the key. So looks like there's some upside here. Folks, uranium space is changing. We can't tell you when it's going to change, but it's coming, and when it comes, it'll go off very fast. And I'd ask you to consider Goviex if you're interested in uranium in Africa, but I would have to say with African pros who know what they're doing in that continent, both on the technical side and the investor side. Daniel, I appreciate your time.
It's a pleasure. Absolute pleasure.
It's a pleasure to know you. And folks, that's it for now. Ciao for now.